Silver didn't just rally, it replaced gold in the safe haven conversation. That doesn't happen by accident, and it doesn't happen quietly. It happens when a system crosses a threshold, when debt is too large to tighten into, when trade becomes a political weapon, and when the market stops asking what does the government call safe, and starts asking something far more dangerous: what survives when policy starts improvising? Here is the thesis, stated as cleanly as I can state it. The silver surge is not a random trade. It is the predictable output of a repeating four-stage pattern that shows up every time a debt-saturated economy collides with a trade shock. And once you see the pattern, you stop watching charts like entertainment and start reading them like warnings. Stay with me for 3 minutes, because the payoff here is practical. 3 facts anchor this moment. Write these down if you need to. First, global debt. The Institute of International Finance estimates global debt rose by roughly $29 trillion in 2025, landing at approximately $348 trillion, an all-time record. That number is not a flex, it is a ceiling. It limits how aggressively the world can tighten policy before the interest bill turns into a political crisis. Second, tariffs. In late February 2026, the United States invoked Section 122 of the Trade Act of 1974. A statute that explicitly allows a temporary global import surcharge for up to 150 days, capped at 15%. The White House set the surcharge at 10%, effective February 24th, running through July 24th. Regardless of whether that rate is 10% today or 15% tomorrow, the signal is the same. Trade policy is being rewritten under pressure, with a countdown clock attached. Third, the market's response. As of February 2026, silver futures are up nearly 30% year-to-date, beating gold's roughly 20% gain. Analysts describe silver as on track for a 10th consecutive monthly advance. Silver spiked to nearly $150 an ounce in late January, then fell sharply, because silver is violent like that, but it remained dramatically higher on the year. Record obligations, trade regime turbulence, and an asset that usually behaves like an industrial metal suddenly behaving like emergency collateral. Now here's what I'm going to do. I'm going to build a 4-stage mechanism, simple enough to fit on a napkin. Then I'll prove it with 3 historical case studies spanning centuries. Then I'll apply it to right now, forensically, step by step. And at the end, I'll give you one dashboard indicator, one single relationship to watch, that tells you whether we're looking at a temporary speculative spike or something much deeper. No hype, no price targets. Just structure. Here is the mechanism. Stage 1 is the trust build. A long period of stability trains people to believe that paper promises are solid. Currency, bonds, trade agreements, central bank credibility, the idea that rules don't change suddenly. This stage is psychological infrastructure. The habit of trust is what makes leverage possible. Everyone borrows against a future they believe will resemble the past. Stage 2 is the overextension. Obligations grow faster than real productive capacity. Debt climbs, leverage spreads, political promises multiply. The system becomes more efficient, meaning it has less slack, and therefore it becomes fragile. Stability is now financed. It looks like calm, but the cost is being pushed into the future. Stage 3 is the loss of control. A shock hits. War, energy scarcity, supply chain fracture, political backlash, trade conflict, and the old promises cannot all be kept at once. Policymakers reach for emergency tools: tariffs, controls, subsidies, legal pivots, temporary measures that somehow keep coming back. The public realizes policy is reacting, not steering. Confidence begins to crack. Stage 4 is the repricing. Markets revalue the currency system through scarce collateral, real assets that cannot be easily diluted by decree. Gold typically leads because it is the clean monetary hedge. Silver often explodes because it is a hybrid, part monetary metal, part critical industrial input. The market is smaller, so flows move price faster. Trust build, overextension, loss of control, repricing. That's the machine. Now let me prove it actually runs. 3 case studies, same 4 stages, different centuries. Start with the United States, 1971 into the late 1970s, the modern template. After World War II, Bretton Woods created a stability regime. The dollar was linked to gold. Exchange rates were managed. The United States sat at the center of global settlement. Businesses planned with confidence because the unit of account felt anchored. That's stage 1. Then the overextension, war spending, domestic programs, dollars piling up overseas. Foreign claims on U.S. gold rose faster than actual reserves. Too many claims, too little backing. The promise became mathematically stressed. Then the loss of control. August 1971, the U.S. closed the gold window. The constraint was gone. Then the real shocks arrived. The 1973 oil embargo, the 1979 energy crisis, stagflation. People stopped believing that modern policy could deliver stable prices and stable growth simultaneously. That belief was the whole architecture. When it cracked, behavior changed overnight. Stage 4, hard assets surged. Gold rose. Silver rose more violently. The system only reasserted control through deliberate pain, tight monetary policy, a brutal recession, and a credibility reset under Paul Volcker. The key lesson is not the exact peak, it's the sequence. Remove constraint under fiscal pressure, absorb an external shock, then reprice into scarce collateral. Now go back further. Weimar Germany, 1919 to 1924. The template for politically impossible obligations solved by the printing press. After World War I, institutions still functioned, currency still worked, people still believed it would work. Trust is sticky, until the moment it isn't. That's stage 1. The overextension. Reparations collided with domestic rebuilding. The state faced a fiscal math problem where every solution was politically unacceptable. Pay externally, stabilize internally, avoid unrest, do it without austerity. When promises conflict, one of them breaks. The question is always which one. Stage 3. The state reached for the tool that delays pain, money creation. Printing substituted for taxation and hard choices. Then 1923 arrives. The Ruhr is occupied. Production is disrupted. Printing accelerates. But the most important event is not a date on a calendar. It's the moment trust flips. People shift from prices are rising to money is melting. Velocity accelerates. Holding currency becomes a guaranteed loss, so people sprint out of it as fast as they can. Stage 4. Society flees into real assets, foreign currency, land, goods. A forced reset leads to a new currency and eventual stabilization, but the deeper outcome is psychological. An entire population learns permanently that paper promises can be rewritten. Now go back even further. Rome and the debasement trap, the ancient template. Rome's coinage was trusted because the empire could tax, enforce, and trade. The coin wasn't just metal, it was a symbol of order. A trusted unit of account enabled long-distance commerce across the known world. Stage 1. Then the overextension. Expansion slowed. Military costs rose. Obligations outpaced inflows. When conquest stops funding the machine still demands fuel. And so the state did what every desperate state does. It reduced the metal content of coins while keeping the face value. Debase the unit instead of admitting the budget won't close. Stage 3. Debasement signals to every merchant that the state will dilute their claims. Prices rise. Trust fractures. People hoard better coins and spend worse ones. An early version of what economists later call Gresham's Law. Edicts and price controls follow. Diocletian's famous price edict in 301 AD. But you cannot legislate trust back into existence. You can only accelerate its collapse. Stage 4. Money becomes weight again. Trade becomes local and suspicious. Real value migrates toward goods, land, and whatever holds value when policy is desperate. The official unit still circulates, but the real economy operates on a shadow standard. Different eras, different technologies, different political systems, same machine. Now comes the only part that matters for your actual life. We apply it to today, and we do it with discipline. If the step matches, I'll say it out loud. If it doesn't, I'll say that too. Stage 1, the trust build. For roughly 3 decades, the global economy ran on a stability story. Trade liberalization expanded supply chains. Low-cost production suppressed inflation. Central banks built reputations as crisis managers. Every major wobble seemed to end the same way. Rate cuts, liquidity, recovery. A whole generation learned one reflex. If something breaks, policy will catch it. That expectation isn't a theory. It's learned behavior. Check. Stage 2, overextension. Easy money and repeated backstops encourage leverage everywhere. Governments, corporations, households. And once a system becomes debt-dependent, the definition of normal rates changes. When the interest bill threatens budgets and politics, the system's tolerance for tight policy shrinks. Here's the part most people miss. Debt doesn't just increase risk, it narrows the range of acceptable policy responses. In a low-debt world, you can spike rates, cause a recession, and survive politically. In a high-debt world, every rate hike is simultaneously a tax increase, flowing through mortgages, corporate refinancing, and government debt service. That's why high debt isn't just finance, it's governance, verified. Stage 3, loss of control. This is where tariffs stop being a headline and start being a structural force. Section 122 is explicit, temporary, capped, 150 days. That is not a minor detail. It is the definition of Stage 3 in real time. Policy improvisation under a countdown clock. And tariffs don't just add costs, they add uncertainty. Uncertainty forces companies to carry more inventory, duplicate suppliers, reroute production, hedge inputs. Every one of those responses has a price tag, and that price tag doesn't politely show up in one data point and disappear. It gets embedded in planning horizons. Notice also that the proclamation frames the surcharge as a response to fundamental international payments problems, a serious balance of payments deficit. That is not free trade language. That is emergency language. Undeniable. Stage 4. Repricing. Look at the asset the market chose to express this through. Silver. Up nearly 30% year to date, beating gold. Running a streak analysts are calling record length. And beneath the flow story sits a structural story you can verify. The Silver Institute's February 2026 outlook expects a sixth consecutive annual deficit around 67 million ounces. Total global silver supply is forecast to rise only modestly, around 1.05 billion ounces, while industrial fabrication alone demands roughly 650 million. Physical investment demand is forecast up 20% to around 227 million ounces. In plain English, the market is already tight, investment demand is returning, and this metal sits inside the hardware of the modern economy. Check, verified, undeniable. The present matches the pattern. Now ask the right question. Why does silver hijack the safe haven trade in this particular kind of crisis? Because this is not a pure monetary panic. It is a combined monetary and physical panic. Gold is mostly a referendum on trust in paper promises. Silver is a referendum on trust in paper promises plus trust in physical supply chains. And tariffs attack supply chains by design. That is not coincidence. It is causality. If you remember one line from everything I've just told you, let it be this. In a tariff regime, safe haven stops being only about money. It becomes about inputs. That is why silver is dangerous, and that is why it is useful. Dangerous because it is violent. It overshoots. It snaps back. We just watched it spike near $115 and then fall hard. The market doesn't care about your entry. It cares about clearing. Useful because it is one of the very few assets that hedges policy disorder and physical scarcity simultaneously. Let me give you the logic chain, compressed as tightly as I can make it. Tariffs raise the probability of higher costs and supply disruptions. Record debt raises the probability that policymakers cannot respond with clean, sustained tightening. When tightening is constrained, real rates struggle to stay convincingly above inflation risk. When real rates are constrained and uncertainty rises, capital hunts for collateral outside discretion. Gold is the classic version of that collateral. Silver is the version that also hedges the physical economy. That is the chain. No conspiracy required. Now I want you to do something most people won't do. Right now, before you move on, decide which fear you think dominates the next 6 months, inflation or recession. Just one, in your head. Because that choice determines how you read everything else. If recession fear dominates, silver should underperform gold. Industrial demand gets questioned, volatility gets punished, and the monetary hedge without the physical bid isn't enough to justify the premium. If inflation and intervention fear dominates, the messy kind where prices rise while policy throws sand in the gears, silver often outperforms, because it functions as both the monetary hedge and the physical hedge at the same time. This is why the dashboard indicator I want you to watch is not silver's absolute price, it is silver relative to gold. When silver outruns gold in an environment like this one, the market is telling you the dominant fear is not simply growth is slowing, it is policy and prices are becoming less controllable. And that fear is coherent in a debt-saturated world, because high debt reduces how aggressively the system can fight inflation without breaking something else. The systemic revelation is not silver is magical. It's the system is trapped. Now let's deal with the mistake that gets people destroyed, confusing the mechanism with a straight line. A mechanism can be correct while the trade is brutal. Silver can be the right signal and still punish you with 15%, 20% swings that feel personal. Size matters more than conviction here. Liquidity matters, time horizon matters. Chasing parabolic moves is how expensive lessons get learned. Use silver as a stress gauge, not a savings account. One more thing about the tariff clock, because this is where most analysis stops too early. When policymakers reach for a temporary emergency tool, markets don't only price the tool, they price what comes after. Escalation, retaliation, exemptions, investigations, new legal mechanisms stacking on top of old ones. They price uncertainty becoming the new normal, so even if the specific surcharge rate changes, the regime signal is already sent. Trade is now a lever of national strategy, not a neutral efficiency machine. And trade regimes shape price regimes. When trade friction falls, goods get cheaper, inputs stay abundant, inflation is easier to suppress. When trade friction rises, Redundancy replaces efficiency, inventories rise, defense spending rises, and corporate planning shifts from cost minimization to resilience. Resilience is expensive. This is how you get a world where inflation pressure persists, even when growth is weakening. The stagflation logic that makes central banks sweat. And when central banks sweat inside a debt-heavy world, markets buy collateral outside discretion. Now pair that with the physical side. The Silver Institute explicitly notes the market will continue drawing down above-ground inventories, adding pressure to an already tight physical market. In a surplus market, fear spikes fade. In a deficit market, fear spikes can become regime shifts. And when investors and industries both want the same metal at the same time, you don't get a smooth curve. You get gaps, squeezes, violent pullbacks, and headlines that sound like a casino. But underneath all of that, you get a consistent structural bid. People want insurance. Here is a simple 3-question audit you can apply to every new headline you see between now and July. Does this headline increase policy uncertainty? If yes, it supports Stage 3 continuing. Does it increase the probability that inflation stays sticky? If yes, it supports the hard asset repricing thesis. Does it reduce the system's ability to tighten without triggering debt stress or political damage? If yes, it strengthens the case that scarce collateral stays attractive. Answer yes to 2 of 3, and the environment is still favorable for hard asset hedges, even if price chops violently. People always say, this time is different. They usually mean one of 3 things. American exceptionalism, the belief that reserve currency status removes constraints. It doesn't. It changes the timing and the channels. Modern central banking optimism, the belief that policymakers have finally mastered cycles. If cycles were mastered, emergency tools wouldn't keep coming back, and global debt wouldn't be sitting at a record. Technology salvation, the belief that innovation cancels scarcity. Technology often relocates scarcity into new bottlenecks: energy, chips, strategic metals, physical infrastructure. The bottleneck moves, it doesn't disappear. This is not different in the way that matters. It is the same machine under a different skin. 3 practical takeaways before I let you go. Stop thinking in single assets. Think in exposures. Ask yourself honestly what you're actually exposed to. Inflation, growth shocks, policy volatility, currency confidence. If you can't answer that cleanly, you're not managing risk. You're guessing. If you touch silver, respect its nature. It is not a stable hedge. It is a high volatility expression of systemic stress. Sizing matters more than conviction. Do not chase parabolic moves. Use the dashboard. Watch silver relative to gold, not the absolute number. If silver continues to outrun gold while tariff uncertainty remains elevated, the market is telling you the fear is structural, not temporary. The Silver Institute noted the gold-to-silver ratio fell below 50 in January 2026, a level last seen in 2012. When that ratio compresses sharply, it's often the market signaling that stress is migrating into the physical economy, not just the financial one. Between now and the July 24th deadline, watch for 3 concrete signals. First, whether the surcharge gets modified toward 15% or whether new trade authorities begin stacking on top of it. That tells you whether Stage 3 is cooling or escalating. Second, watch the list of exceptions and exemptions. When exemptions multiply, it's usually not free trade returning. It's the political system discovering real-world shortages and trying to patch them without admitting the policy is inflationary. And third, watch that gold-to-silver ratio. Markets will not wait until July 23rd to decide what comes next. They will decide early, and they will move early. That's what you're watching right now. So, in the comments, one word: inflation or recession. That's it. Because that single word tells me, and tells you, what you're actually betting on whether you admit it or not. Drop it below. And if you want the next piece, how this machine was built, how debt and trade policy became a single feedback loop, and what the next stage looks like before it becomes obvious, hit subscribe. Because the next stage is not going to announce itself politely. Silver already did.